Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi, welcome to Retiring Well. In today's show, I want to talk to you about stock picking. Let's call it Stock Picking 101, okay? Just some things that you want to know when you're looking at buying individual stocks. Now, in today's environment, we've got a lot of custodians out there now charging zero commissions or fees for trading in the accounts. We've seen this be on the rise, especially during this pandemic. We've seen people now, having a little bit more time on their hands, sitting at home, maybe having a little more time to kind of look and research stocks. When the market kind of dropped quite considerably there in March, they thought, hey, there might be some buying opportunities. So we've seen all kinds of trading happening. We've seen companies like Robinhood just explode because they've got a trading platform, very user-friendly trading platform that a lot of people have jumped onto, most particularly the younger, maybe 25 to 30 years old. And so you've got this Robinhood, launches maybe 5, 6, 7 years ago, I believe, and they're already up to 10 million users. 10 million users out there with a lot of time on their hands, just sitting there looking and buying stocks. It's been crazy. If you saw the example just a couple months ago with Hertz, literally filing bankruptcy, and their stock, the following week goes up 500%. Makes absolutely no sense at all. Why that would happen, other than the fact that you've got these people out there thinking Hertz is going to come back and they're just going to buy the stock. So you got this phenomenon happening. Now, just getting back to that custodian issue, how did they make money, not trading any fees or commissions for the trading? I've had a lot of people ask me that. Well, how they do it is, it's not necessarily where they in the past made most of their money. They actually make money in cash accounts. All right, so a lot of people have set up these trading accounts. They'll have a certain amount back in cash. It's that cash that's sitting there that they're able to make money off of. So that's where they really get a lot of their revenue, and that's why you can enjoy no trading costs or fees. Now, what are some things you want to look at when you're looking at a stock to buy? Okay. Now, first of all, some of this information I'm going to give you, you might be asking, where am I going to get this information? Well, a lot of times you go on your web browser on your computer. There's a little section there for stocks where you can put the ticker in, and the ticker is the ticker symbol that comes with a stock, and you can look at that. All kinds of information is freely available that way. One I might use is Yahoo Finance. All right, just go yahoofinance.com and you'll see that section. And so all this information I'm going to be talking about, you can get there. Okay. So I've got a stock I'm looking at. I go into my web browser, I put the ticker in, and I got all this information available to me. What are some things I might want to look for? Well, one is look at its past performance. Has revenue been on the rise? Year after year. They usually will go back about 3-4 years. Have earnings been on the rise? Let's look at the trend. I mean, if you've got a company with rising revenue and rising earnings, as you look at the price of the stock relative to that, does it warrant, you buying it? Maybe. That's one thing you might want to look at. You're going to hear me say this time and time again. Earnings are probably the most important thing for a stock, right? A stock that has no earnings is never going to be able to pay you a dividend. Unless it continues to just keep borrowing money, is not going to be sustainable in the long haul, right? So a company with no earnings, buying into that is highly speculative, right? Now, there are exceptions to the rule. I think of Amazon. For a number of years there in the early days, they did not make money. Would have that been a stock I would have been very excited about early on? No. But had I known where Amazon was going and I bought into that stock that early, I'd be a very happy man today. So, sometimes you can get into these early stages of a stock you think are going somewhere, but know that it's highly speculative when you go into it if it doesn't have earnings. Now, as a general rule, the market is traded at a multiple of its earnings. Okay, um, historically, that's been about 17 times earnings. So if you look at the market, um, relative to the value of the underlying corporate earnings, if it's a little higher than that, then we may be getting into, I wouldn't say bubble territory. I mean, if it gets really high, it would. But it might be getting into what we call overvaluation territory. Now, of recent years, they've said that the PE ratio is justified to be a little bit higher because of the low interest rate environment we find ourselves in. They don't have to have as much earnings because interest rates are low. So that basically justifies a higher multiple. All right, and it had been up there for quite some time. So you take that as a general rule, and then look at an individual stock. What is its PE ratio? If the market as a whole is trading at 20 times earnings and the stock you're looking at is trading at 30 times earnings, is it maybe possibly in overvaluation territory? All right. Now, some stocks deserve a higher, what I would say, multiple. So, for example, technology, which is not, doesn't require a lot of capital investment, can generally get a little higher multiple. I think, as a general rule, technology stocks might be trading at about 30 times earnings when the S&P might be at 20 times earnings. So, you want to be wary of that. What kind of sector you're in, does it warrant a higher multiple? But as a general rule, if you look at a stock, look at that PE ratio to make sure it's not too high. So you're looking at revenue trends, you're looking at earnings. Next thing you want to look at is earnings per share. What is that stock yielding, are making for income? What's that bottom line? If it's a stock that's making, 3, 4, 5%, okay, then you look at what is it paying out in dividend. Well, you want that earnings number to be as high as possible, right? Because if it's you want it to pay a dividend. So if you got a stock that's maybe making 4 or 5%, maybe paying 2, 3% in dividend, what's that tell you? That means it's able to pay a good dividend. It's probably going to be very consistent to continue to pay that dividend, and it's still making a little bit more towards that they can use for capital investment. So earnings very important. Now you want to be careful with a lot of these companies. A lot of their these executive bonuses and management is tied to what their earnings per share is. So they always want that to be to look good. All right, it's probably the best way to put it. So quarter after quarter, they've got great pressure to continue to grow that earnings per share, continue to make it look good. But one thing they can do that may not be a good thing is sometimes buy their own stock back. And they can. We've seen a lot of corporations in recent years go out and get cheap money that's been available, with all this quantitative easing, and then they turned around and took that money, and rather than take that money and put it into capital investment, they basically take that money and buy their own stock back. You go, well, Larry, why? How do they do this? Yeah, so you got these companies that are basically buying their own stock back, but their earnings went down. But by having less outstanding shares now out there, they basically can manipulate and keep their earnings per share the same, and yet the earnings were going down. So that's not going to be a good thing. All right, another thing you want to look at is the price to book. Now, what is the book value of a company? Okay, the book value is you've got its assets, and a company has liabilities or its debt. Okay. So it's got, let's say it's got assets of, I'm using round numbers, but $1 million, and it's got debt of 800,000. That means it has equity of about 200,000. That would be its book value. Okay. So one thing you look at is if you got the market value of all the stock divided by its book value, you want to see that preferably be 1-to-1. That's good value because with the stock you're buying directly into the equity or book value of that company. Anything less than 1 is a premium. So you can look at any stock and it's got a book, what I call the price to book of 1 or less. That's attractive. Okay. that's going to be desirable. Another thing you might want to look at is what's called price to sales. Okay. Now, a lot of people like to use this as a way to look at a stock because sales can't be manipulated. Remember earlier I was telling you how a company through buying back their stock can, manipulate, the earnings per share number. So that might not be something you want to solely rely on. But the price to sales, which is the market value of stock compared to its revenue, you can't manipulate that because revenue is revenue, right? It's either going up or it's going down. So if you have a stock that's, price of the stock is rising, yet the sales are going down, and that stock is, like I said, trading upward of that, yet the sales go down, well, maybe that's something that may not be good, something you're definitely going to want to take a look at. So again, most of this information, there's other things like the 50-day moving average, the 200-day moving average, and relative to where the stock is it below, above that or below that? Usually, if it's above, you're getting into bullish territory. If it's below those averages, you're getting into bearish territory. Those are all good things you want to take a look at, and there's plenty of information out there. But honestly, most people would just prefer to have somebody help them with the management of stocks. And here's why. I can look at any stock today and tell you whether you should buy it or not based on a number of different criteria. But then once I bought that stock, now I got to know when to sell it. Now, so I've got to be looking at this every single day to decide, are those trends changed? There's just so much that's moving out there that, that's a hard task. Unless I'm that person that just wants to buy that stock and hold it for the long haul and don't look at it again, and I can trust that, you're going to want management of that portfolio. The advantage you have with management of portfolio is that you've got these companies that are dealing with billions of dollars. And so they can spend millions on research that is not available to you and I. And so with that research, they can dive into all that other stuff that we can't get into in making those buy and sell recommendations. You've got plenty of people that are there doing the trading. They typically have a very good idea when they want to buy, when they want to hold, when they want to sell, and the timing thereof. So there is some value in professional management and the research that comes behind that. And then, looking at the track record of that management, what have they done in the past? If they've continued being able to outperform the index, as a general rule, I'm gonna trust that management and kind of get behind them. Now, a lot of people will say, Larry, I would prefer to have management of a portfolio, but I'd like to have the ability to have some account over here, what I call play money, that I can kind of buy some stock and, buy and sell and kind of play around with. Perfectly acceptable, as long as you're just not throwing all your eggs into one basket. Okay, so we'll have people do that. That's perfectly fine. If you're on your own, you have to understand it's speculation. Again, getting back to that Hertz example, you got people emotionally react. They think Hertz, they've seen the name for a long time. They not believing that it's going to go anywhere. It's going to somehow rise from the ashes and be good again. That's totally speculation when you head down that route. It's talked about Hertz. Their assets met their liabilities, meaning there was no book value or equity there. Very, very, very little. So here I am buying into a stock. If I'm buying into Hertz, where if it goes bankrupt and it sells all its assets off to pay its debtors, there's nothing there for the shareholders, right? So again, when you get involved in stocks, just know that it's highly, highly speculative.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Hi, my name is Jack Clunder and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Now, one thing a lot of people like to do is what they call put stop losses on the stock, okay? That means they can, when they buy the stock, they can say, if that stock goes below a certain price, then I want it sold. Not typically a huge fan of stop losses, only because sometimes if the markets are volatile and the price on the market side tends to drop below that spot, then it's going to sell off whether you wanted it to or not. You may not want it to. Maybe the next day it bounced back and you miss that. Okay, so I'm not a big fan of those. But one thing I kind of am probably more of a fan of is what's called trailing stop losses. Okay, this is where you can set it when you buy the stock, you can set it as maybe like a percentage of that stock. So, but that percentage stays. So if the stock grows in value, then that stop loss that trails with it. So let's say I buy a stock for $100 and I put a 10% trailing stop loss on it, okay? And that stock goes up to $110, okay? Now drops 10% real quick. Now I got sold off at 100 at the price I paid for it. I didn't lose that percentage as it grew. So if I'm out there, I have these stocks and, markets are volatile. I want to hold on to them because I want some growth, but I'm also concerned that if things drop below a certain amount that I could lock in some of those gains I had. Trailing stop loss would be very advisable to do. Now, when you're looking at individual stocks, that's fine. I gave you kind of just some basic parameters to look at, but you want it, most particularly, you want to pay attention to more macroeconomic forces. What's going on globally, what's going on in our own country from a macroeconomy standpoint, right? Because as a general rule, if the economy is doing good, consumer confidence is high and unemployment is low, people got more money to spend, the economy is doing well, that's going to be good for corporate earnings. And if corporate earnings are good, that's going to be good for the market price, as I talked about earlier. I could show you a chart with corporate earnings over time, and I could show you the market price of stock over time. They almost go hand in hand. So as long as earnings are growing, market typically has got some room to grow. If earnings are flat or going down, you're going to see if the market may go up for a period of time, but eventually it's going to adjust to its mean or match the earnings. So watching macroeconomic forces at play is huge. Now, one thing that's caused a lot of uncertainty with this pandemic is that, we don't know where it's going. Some think it's going to be a quick recovery and be right back where we were. Some believe it's going to be a long haul before we get back to where we were, and corporate earnings are going to start to go down. Who knows where that's going? It's only anybody's guess. But paying attention to what's happening and where earnings are going is going to be very important, because that's going to give us a better feel as to whether we should be, higher in equities or not. It's hard today to have what I call safe havens. What I call by safe havens is those stocks that are going to weather the storm. How about that during harder times? There's so much out there with index funds today that it's really hard to not get caught up in what they call systematic risk, or all ships rising and falling with the tide. And let me just give you an example. Let's say I'm that person that has that 5 best stocks. Let's say it's those FANG stocks, Facebook, Apple, Amazon, Netflix, and Google. Okay, I've got those 5 stocks, and I think they're going to continue to do well even through this pandemic. But those 5 stocks, they're also part of the S&P 500. Okay, and there's a lot of index funds out there that own the S&P 500. So people get scared. They start to get out of stocks. They get out of their index funds. Well, guess what? When they get out of that S&P 500, out of that index fund, and your 5 stocks, the FANG stocks, are part of that S&P 500, the baby's getting thrown out with the bathwater. Okay, they're selling off your stocks, even though you might think they'd be good, because they've gotten out of their index fund. We call that systematic risk. Now, do those stocks have a better chance of coming back after that market fall? Yeah, but if you're holding those stocks individually and you don't want to see a lot of volatility and that kind of thing is happening, it's hard to kind of protect yourself in that kind of environment when you've got so much now in index funds. All right, you want to be careful also of what we call getting caught up in what's called the herd mentality. There's a really cool indicator out there called the Bank of America Merrill Lynch sell side indicator. And it's been incredibly accurate at predicting what the market's going to do in the next 12 months by doing the opposite of what Wall Street is thinking. So as a general rule, when Wall Street has been very bullish, the market in the next 12 months has been down. When Wall Street has been very bearish, the market's actually gone up. So it's kind of a contrarian indicator. But what it's really indicative of is this herd mentality, right? I mean, the idea that everybody's believing it's going to be good, and it's probably going the other way. I say good investing typically feels like you're going the wrong way down a one-way street, because when the herd is going this way, you want to maybe be going the other way. So, experience will tell you if you've been doing this for very long. You want to pay attention to that, because it just seems like when you get into that euphoria stage, and everybody's jumping in or piling in, there's this fear of missing out, and everybody's buying into stocks, and it feels like you need to be getting in yourself because you're missing out on it. Dare say kind of have a little bit of a contrarian viewpoints by saying, you know what, everybody's going one way. I'm going to maybe be careful about what's happening here. The opposite is true when you're at the bottom of a bear market. There you've got absolute despair. People feeling like it's never going to come back. I wouldn't dare ever go into equities again in my life. When you feel that kind of sentiment happening, generally indicative of the bottom of a bear, maybe good time to start getting in. So just, nobody has a crystal ball, but having a sense for that is not always a bad thing. Folks, I hope you found this valuable. If you got anything out of this, just know that if you're dealing in individual stocks yourself, you better have a game plan. You better know what some things to look for are. Speculation is fine, but again, you don't want to throw all your eggs at one basket, right? Try to be diversified. But there is great value in having management of your accounts. And at Centennial Wealth, that's what we do. If we could be of any help with you, kind of hooking you up with, those good managers that have the research, that have a track record, then by all means, give us a call. The number's on the screen. But again, thank you for joining us today. Again, give us a call if we could be of any help. Thank you.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no obligation retirement review.
We look forward to helping you plan to retire well. Are you drawing closer to retirement or already retired? Do you feel confident that you have a plan in place for your retirement? At Centennial Wealth Advisory, we believe there are a number of areas within your retirement plan that must be working together. It's very important that you have a long-term income plan. You don't want to run out of money in retirement. And we believe that tax planning should go hand in hand with your income planning. So we have our very own accountant on the team to assist you. We also believe that you need to have your estate planning in order to ensure that your assets are left behind to your loved ones and or charities. Along with that comes insurance planning, whether that's life or health. Along with all of this, obviously comes your investment planning, which you need to have confidence will help you accomplish your goals and objectives. As you can see, there's a number of areas that you need to be taking into consideration when it comes to your retirement planning. We'd love the opportunity to share with you how we approach all of these areas within your retirement plan. Please call the number on your screen.